Our group undertook the Acuna simulation module 2301, where we have a restriction of a delta of 0 and a self-imposed restriction of a vega of 10,000. As we will soon see, there will be some cells which light up as red. These provide an indication of trading opportunities. We begin trading in these red cells, which involve calls, puts, and combinations, as these provide good edge. By doing so, we can see on the bottom graph that delta begins to substantially become negative, going to -10, where we purchase 10 futures in order to keep delta neutral.
At this point, we realized that we had mistakenly underestimated the volatility present in the market and we were incurring losses. The initial portfolio was negative vega and gamma. In hindsight, this was naive when considering that we were early into our position and negatively hedged against future volatility movements. The large short position in call options of our portfolio became less and less profitable as the future price trended upwards. This led to a smart decision to increase overall implied volatility in order to increase the theoretical values in quotes and to induce the market to sell a stock. This was a good early decision to reduce our position and exposure to the Greeks. However, we introduced a net positive gamma and vega instead of completely hedging the Greeks in order to allow us to make profit off the future anticipated movements in the underlying price. A profitable move that we did is that every time we opened up a position in the market, we would close it quickly with either another option with a similar strike price or the same strike price. This meant we did not expose ourselves to massive vega or other Greek risk while constantly gaining the edge of the trade. This was evident by looking at our trade position. Each strike price option was covered by either the immediate upside or downside corresponding strikes.
Just now, we purchased some calls at a strike price of 420 with a theoretical price of 2.871. We noticed that in the market, some other individuals have made a similar transaction, purchasing calls at a strike price of 420, but with a slightly different theoretical price of 2.862 and 2.865. We also noticed that for the same option, the theoretical price is actually now fluctuating around the value of 2.88, which is substantially higher than the 2.862 and 2.865 which we previously observed. Since the theoretical price is much higher than the one that we see in the market, there is a possibility that we may have overpriced our options. In order to reduce the theoretical price to match that of the market, we should reduce the implied volatility in our model.
In the final trade list, we can see a snapshot of the trades we've made. This presents that we've made comparable volume of trades in both selling and purchasing options that are analogous in magnitude to ensure that we remain hedged. This is further supported by the T-POS column, which nicely reveals the total net long or short call and put position that we've conducted and confirms variations in the executed trades.
At the end of the simulation, we attained a final profit of 4,430. Looking at our risk matrix, our Greeks are well within and very close to neutral due to our trading strategy to balance our net long and short portfolio position. The biggest risk is if the price of the underlying surges by more than 5%. We would have a negative profit and loss, and our Greeks would approach our risk limit. But we can counter and re-neutralize our Greek position by purchasing more options as price of the underlying increases. Our best outcome is if price of the underlying decreases for large values, leading profits to increase exponentially while keeping our Greeks in check and consistent. We will need to increase delta slightly by purchasing futures of the underlying stock to keep our portfolio delta neutral.